Several of you have been asking the same question in the comments this week. My 401k went down again. I do not know what is in it. I do not know if I am on track, and nobody is giving me a straight answer. Today, we are going to fix that. This is the Vault Keeper. Here is the honest truth that most financial channels will not tell you. The average American is losing between 1% and 2% of their retirement savings every single year to fees they do not even know they are paying. That does not sound like much. Over 30 years of investing, that 1% to 2% difference in fees costs the average household between $100,000 and $200,000 in lost retirement wealth. Not because of a market crash, not because of bad investments, because of fees that were always there, buried in documents nobody reads. The average American 401k lost between 15% and 20% of its value during the 2022 market correction. And right now, with the S&P 500 CAPE ratio sitting near the highest levels since the dot-com bubble in 2000, the risk of another significant correction is real and documented. Most Americans have no idea what funds are inside their 401k. They picked something when they started their job, signed a form they did not fully understand, and never looked at it again. That is the most expensive financial mistake the average household makes, and it is completely fixable. There are 3 things every American should audit in their 401k right now, not eventually, right now, before another market correction catches you unprepared. The first thing to audit is your expense ratio. Every fund inside your 401k charges an annual fee called an expense ratio. This fee is deducted automatically from your returns every single year, whether the market goes up or down. The average actively managed mutual fund charges between 0.5% and 1.5% per year. A low-cost index fund tracking the same market charges between 0.03% and 0.10% per year. That difference, often more than 1% annually, compounds silently against your retirement balance for decades. A $100,000 portfolio paying 1% in annual fees loses approximately $28,000 more over 20 years than the same portfolio paying 0.05% in fees. That $28,000 does not go to your retirement. It goes to the fund manager. How do you find your expense ratio? Log into your 401k account. Find the list of funds you are currently invested in. Search the fund name followed by the word prospectus. The expense ratio will be listed clearly. If it is above 0.5%, you are almost certainly overpaying, and there is almost certainly a cheaper alternative inside your plan. The second thing to audit is your asset allocation. Asset allocation means how your money is divided between stocks, bonds, and cash equivalents. The appropriate allocation depends entirely on your age and your time horizon until retirement. A 35-year-old with 30 years until retirement should hold a dramatically different allocation than a 55-year-old with 10 years until retirement. The most common and most expensive mistake Americans make is either being too conservative too early, holding too much in bonds when they have 25 years to ride out market volatility, or being too aggressive too late, holding too much in growth stocks when they are 5 years from needing the money. A general rule that most financial planners use as a starting point is subtracting your age from 110 to determine your stock allocation. A 40-year-old would hold approximately 70% in stocks and 30% in bonds. A 60-year-old would hold approximately 50% in each. This is a starting point, not a final answer. But if your current allocation is dramatically different from this baseline, without a clear reason why, it is worth examining. The third thing to audit is your exposure to overvalued growth stocks. The S&P 500 is currently concentrated in a small number of large technology companies at valuation levels that have historically preceded significant corrections. The top 10 stocks in the S&P 500 represent over 35% of the entire index. If your 401k is heavily weighted toward large-cap growth index funds, you may be carrying more concentration risk than you realize. Diversifying into small-cap funds, international funds, and value funds reduces your dependence on a small number of companies continuing to grow at extraordinary rates. Now here is the practical question. How do you see all of this in one place without spending hours digging through your 401k portal? Personal Capital is a completely free tool that connects to your 401k, your IRA, your bank accounts, and your investment accounts in one dashboard. It shows you your complete net worth in real time, your asset allocation across all accounts, and most importantly, it runs a fee analyzer that shows you exactly how much you are currently paying in fees and what that costs you over the life of your retirement. It has shown users they are paying thousands of dollars more per year than they realized. The link to create your free account is in the description below. It takes about 5 minutes to connect your accounts, and the fee report is available immediately. Now let me give you the deeper context on why these 3 audits matter more in 2026 than they did 5 years ago. The Federal Reserve has held interest rates at 3.5% to 3.75% and signaled that rate cuts may be delayed further than markets initially expected. That matters for your 401k in a very specific way. When interest rates are high, bonds become more competitive with stocks as investments. A 10-year Treasury bond currently yields approximately 4.3%. That means you can earn 4.3% per year with zero risk by lending money to the US government. For the stock market to be worth the additional risk, it needs to earn significantly more than that over time. At current valuation levels, with the CAPE ratio near historical extremes, many analysts believe the forward returns on stocks over the next 10 years will be significantly lower than the historical average of approximately 10% per year. That does not mean you should sell everything and move to cash. It means the mix of your portfolio, your asset allocation, matters more right now than it did in 2020 when interest rates were near zero and bonds were paying almost nothing. The second piece of context is inflation. Core PCE inflation, the Federal Reserve's preferred measure, is running above the Fed's 2% target. When inflation runs above your investment returns, you lose purchasing power even when your account balance is technically going up. A portfolio earning 4% per year in an environment where inflation is running at 3.5% is only growing by 0.5% in real terms. Understanding the real return on your investments, nominal return minus inflation, is one of the most important and most overlooked concepts in personal retirement planning. The third piece of context is fees compounding against inflation. If inflation is eroding the real value of your savings at 3.5% per year, and fees are eroding your nominal returns by another 1% per year, you are fighting 2 separate forces simultaneously. The household that eliminates unnecessary fees is starting from a dramatically better position than the household that does not. That is why the fee audit is the single highest return action most Americans can take with their retirement account today. No market prediction required, no timing skill required, just paying less for the same or better exposure. Now let me tell you what to do after you complete the 3 audits. If your expense ratios are above 0.5% on any fund, look inside your 401k plan for the equivalent index fund. Most plans offer at least one S&P 500 index fund with an expense ratio below 0.10%. If your plan does not offer any low-cost index funds, that is information worth taking to your HR department. Employers have a fiduciary obligation to offer reasonable investment options. If your asset allocation is significantly off from the age-based baseline, most 401k plans offer target date funds that automatically rebalance as you approach retirement. A 2045 target date fund, for example, automatically adjusts from aggressive to conservative as 2045 approaches. These are not perfect for every situation, but they are dramatically better than a static allocation that was never adjusted. If your equity exposure is too concentrated in large cap growth, Adding a small percentage to small-cap value funds and international developed market funds reduces correlation without dramatically changing your risk profile. None of these steps require you to be a financial expert. They require you to spend 2 hours understanding what you already own and making adjustments based on information that is available to you right now for free. To see all of your accounts together, track your fee exposure, and understand your real asset allocation in one place, Personal Capital is the tool I would use. It is free. It connects securely to all major financial institutions. And the fee analyzer alone is worth the 5 minutes it takes to set up. Link is in the description below. We are here to give you the information you need to protect and grow the wealth you have worked to build. Drop a comment below. How old are you and how much do you have in your 401k right now? I read every comment and I will give you direct feedback on whether you are on track. Subscribe to the Vault Keeper newsletter for daily financial intelligence before markets open, and use Personal Capital, link in the description, to start your 401k audit today. Subscribe. Turn on notifications. Data before price. The Vault Keeper.